Welcome to another edition of one of our Money Talks videocasts. I'm Jerry Slucewicz, your host. We're trying to give you this educational series, how to become a better investor. One of the things we want to talk about today is asset allocation. A lot of people say, hey, I want to invest my money. How many positions should I be in? How much do I need for diversification? If I'm in mutual funds or exchange traded funds, aren't I diversified enough? Well, the answer is I think that you need to have at least 10 to 20 different positions. The statistical number is 15. Anywhere in 13 to 15 is the range. And so if you start looking at the math on that, you want 5 to 10% of your money in any one position. I get portfolios that I review all the time where they have anywhere from 60 to 85 different positions. And I could never imagine calling up a client and saying, Mr. Jones, I have 63 existing positions in your portfolio, but this 64th idea is the 64th best idea I can come up with. Too much diversification is bad because you want to have positive impact when things work out. Now you could say, well, geez, if you have 5 to 10%, what if things don't work out? Well, listen to my previous video cast where I talk about stop losses. That's how you reduce risk on these 5 to 10% positions. But the real issue is you never want to risk more than 1% of all your capital in any one great idea. So however you decide to diversify, never risk more than 1%. So if you have 10% of your money, again, $100,000, you put $10,000 asset allocation on one position, and you don't want to lose more than $1,000. So you still have 99% of your money left over in case that doesn't work out. So don't risk more than 1%. If you decide to not listen to me and take a larger position, you want to put 25% of your money on one great idea, that's fine. Go ahead, but make sure you risk only about 0.4% to risk about 1% of your overall money on that great idea. So you better be right quickly. So what we're looking for is anywhere from 10 to 20 positions, 5 to 10% each. Now typically what we do is we pyramid in. We'll buy a 3% or a 2% or even a 5% position. If it's making money and going up, then we might add to our position and grow that position. It's called pyramiding. The ancient pyramids of Egypt that are still standing today, they take a big base, add a little bit more, add a little bit more in the winning positions. People hear about dollar cost averaging. If you buy it at 50, buy more at 40, buy more at 30. Wrong. X that idea out. That's not how you do it. How you do it is you add to your winners and sell your losers quickly. So in the asset allocation, position sizing, very, very important that you try to diversify. You don't want to put all your eggs in one basket. You don't want to have all 10 different items that are just S&P 500. There's so many different areas of the world to invest in. You've got stocks, small companies, medium companies, large companies, value stocks, growth stocks, foreign stocks, small, medium, large foreign stocks, emerging markets. You've got the bond market, junk bonds, high yield bonds, government bonds, treasury, corporate, municipal bonds. There's all these different areas. So don't invest only in one sector. Diversify, try to get in around at least 10 different sectors in your asset allocation, and again, don't risk more than 1%. To get more information, become a better investor, you'll look, there's a tab right up above us that says free newsletter sign up. All we're looking for is your email address. If you want more information from us, fill out the rest of it. But sign up for our free email newsletter right up here on that tab. And again, we'll send you out our updates as we get them from time to time. If you got more questions, feel free to call me for your free no obligation portfolio review, toll free 800-449-9501, toll free 800-449-9501. Check back frequently. We'll update this. We'll update it with our podcast and different articles. And again, sign up on that tab for our free newsletter. Have a great week of investing.